Imagine extracting hundreds of thousands of dollars in corporate profit tax-free and without personal tax liability. That is exactly what the Capital Dividend Account, or CDA, allows incorporated professionals to do in Canada. Hi, my name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial, and we help business owners and incorporated professionals to protect and transfer their wealth using advanced Canadian strategies. Today, I'm going to show you how the CDA works, why it's so powerful for your corporation, and how to use it to properly pay dividends tax-free to your family and shareholders. The Capital Dividend Account, or CDA, is one of the most valuable tax planning tools that's available for private Canadian corporations. Yet, many incorporated professionals don't even know it exists. So while it's not listed on your company's financial statement, it does play a crucial role in allowing business owners to extract tax-free money from the corporation. So the CDA is a notional account, which means it's tracked for tax purposes under the Income Tax Act, but it doesn't appear on your financial statements. It's used by private Canadian-controlled corporations, or CCPCs, to keep a running total of a specific tax-free surplus. And then when you use it correctly, it lets your corporation pay out tax-free capital dividends to you as a Canadian resident shareholder. It could be you. It could also include your family members or the other shareholders of the company. Now, what increases the Capital Dividend Account? How do you create it? And so there's 5 types of non-taxable income that can grow your corporation's CDA. Here they are. Number 1. So, when you have a capital gain, only 50% of that gain is taxable. Well, the other 50% of the capital gains that's realized inside your corporation is credited to the CDA. It creates Capital Dividend Account, or increases it. Another thing, number 2, is a life insurance death benefit that pays to your corporation minus whatever the adjusted cost base is. That creates a CDA that can pay out without tax. And then this is a big one if you want to leave your holding company, or if you want to leave corporate shares as a legacy to your family. The insurance can be on you, or it can be on important shareholders or key people of the company. Another thing too is capital dividends. So this is a third one. So these are capital dividends that you would get from another private corporation. So you've invested in something and they're paying you a dividend. These can go to your CDA. And then the other one is your capital gains on what's called eligible investments. So this is most investments that people know, like real estates or shares or funds. So if there's a capital gain on that, the non-taxable part of that capital gain goes to the CDA. When any of these events occur, they create or they increase your CDA, which gives you that opportunity to pay out those capital dividends in tax-free rather than as regular dividends, which would obviously be subject to personal taxes. Now, why does the Capital Dividend Account matter for incorporated professionals in Canada? So if you're an incorporated professional in Canada, so say you're a partner lawyer or a partner accountant, lots of different types of professions inside healthcare, say like you're a surgeon or a physio, or you own a clinic. Basically any business that has good, stable annual cash flow and high margins to generate profit or to generate retained earnings every year, you've probably built this up over some time and you hold appreciating assets in the company. So you've invested in something, or maybe you own a life insurance policy already. The CDA gives you a powerful way to get that money out of the holdco tax-free. So this can help you to reduce your personal tax burden. It can enhance your estate planning a lot, and it can protect your family wealth for generations. And so here's 4 reasons why the CDA is such a valuable strategy for if you're incorporated and you're profitable in Canada. So number 1 is you can lock in tax-free returns on capital gains inside your corporation. So when your corporation sells an asset like a stock or real estate or a private investment, and it realizes a capital gain, only 50% of that gain is taxable at whatever your corporate rate is. And then the non-taxable 50% gets credited to your Capital Dividend Account. So that amount, the non-taxable CDA part, that can be later distributed to a Canadian resident shareholder tax-free as a capital dividend. So that's probably you and anybody that's associated with the company. So for example, say your corporation earns a $200,000 capital gain, 100,000 of that is taxable. The other 100, or the remaining 100,000, that goes to your CDA. So that means you can take out $100,000 tax-free as a capital dividend this year or at some time in the future. Secondly, you want to use your corporate-owned life insurance to create CDA. right? So one of the most effective ways to grow your CDA is by holding permanent life insurance inside the corporation. When you've got a corporately owned life insurance policy and when it pays out after that insured person dies, the death benefit minus the adjusted cost base either creates it or is added to the CDA if you've already got some. So this allows your corporation to receive the death benefit tax-free and then credit the CDA minus your adjusted cost base, and then distribute this capital dividend to the estate or to the beneficiaries of the corporation tax-free. And this is why corporate-owned life insurance is one of the most efficient estate transfer tools in Canada when you're incorporated, if you've got a business. It's a very important planning tool for anyone who wants to pass down the assets of their business or from their holding company to their family or to their kids or to the next generation. So for a lot of our clients, that legacy piece and the generational wealth piece is really important. And this is how you do it. So 3, you can access corporate profits without triggering personal tax. So distributing a regular dividend from your corporation to yourself or to your family would trigger personal income tax, sometimes at the highest marginal rate. But with a properly managed capital dividend account, you can declare a capital dividend instead. And so this special type of dividend is completely tax-free as long as you're a Canadian resident shareholder. So like I said, when you have the 50% of the capital gains taxable, the other 50% creates CDA, but it doesn't have to be paid out right away, and it doesn't have to be paid out all at once. So you can plan when to pay it out. So, well, not you, but your accountant would do this. So you don't plan when to pay this out, your accountant plans when to pay this out. And then this means that you can access your cash from your corporation without selling more assets, or it means that you can avoid the personal tax hit from paying yourself a traditional dividend. And it also means that you can retain more family wealth instead of sending it to the CRA. And then number 4 is you want to use your CDA planning with your family estate and with your business succession plans. So the CDA plays a critical role in tax-efficient estate planning if you have a business in Canada. And then here's 5 times where it really has a substantial effect on how much of your wealth stays in your family versus how much gets taken by the CRA. So here's 5 times. It's 1, when you're retiring and you're extracting funds from your holding company, or you're going to pay yourself from your holding company, when you're setting up a family trust or a spousal trust, or when you're transitioning the business to your children or to key employees, or when you're implementing a corporate estate freeze, so you're freezing the value today and then going to have somebody else take on the value from moving forward. And then when you're structuring what's called post-mortem pipeline planning to avoid double taxation. So the CDA gives you a way to distribute those funds cleanly and efficiently outside of the scope of probate and without increasing your personal tax liability. So you do this with your estate lawyer, but call us to put in place the insurance piece when this happens. This is something that you want done right the first time. Actually, all of these last 5 things I've talked about, all of these situations are really important to work with somebody who knows what they're doing and can set you up with the right plan according to you and your family's specific needs. And not only that, but somebody who can actually get it done and get it done right. So these things are not simple to set up on our end. And most advisors in our industry don't ever really get taught how to set up policies like this to achieve these goals. And in our case, we're doing it to maximize your cash value, maximize your CDA credit, and to make sure that everything runs smoothly for the next decades as we do this together. So this sounds complicated. It's simple, but a little bit complicated. Here's a step-by-step on how to use your capital dividend account, right? It gives your private Canadian corporation this tool to distribute the tax-free capital dividend as long as you're a Canadian resident shareholder. But to take full advantage of the strategy and to avoid any penalties is really important to follow the proper process. And so here's kind of step-by-step on a high level on how you can legally and efficiently use your CDA. So number 1 is you need to know the numbers, right? So you want to calculate your corporation's CDA balance and it needs to be accurate. So you work with your accountant on this, but the first step is really like, what is your current CDA balance? And this involves tracking your transactions that affect CDA. So this is, like I said, the non-taxable portion of a capital gain that you realize inside the corp, any death benefit from life insurance if the life insurance was owned by the corporation, obviously minus the adjusted cost base, any capital dividends that you've received from another private Canadian corporation. And then again, like I said before, this is a notional account, so it doesn't appear on your financial statements. So you need to have record keeping, and it's really important that the record keeping is accurate so that you don't overpay, you don't pay yourself too much, and you stay within CRA compliance. If you're unsure of what is your current CDA balance, you or your accountant can submit a form to the CRA, to the Canada Revenue Agency, and they will tell you how much CDA you have available. Just so you know, the form is called Schedule 89, the request for Capital Dividend Account Balance Verification. That's the whole name of the thing. And if you Google it, it's the first thing that comes up. Do this to confirm your eligible amount before you decide how much to pay yourself out as a dividend. Your accountant, sorry, not you do this, but your accountant do this, but you can also do it yourself. Number 2, once you know what is your CDA balance, then you elect to pay out a dividend, or you don't elect to pay out a dividend. Your corporation can elect part or all of the CDA balance to pay out tax-free, so you can decide how much to pay yourself from the CDA each year. This is important, right? You don't pay out more than your CDA balance because the tax penalties are big. The CRA could reclassify the dividend as taxable. So, you or your accountant should check and confirm the balance that's available before you pay out any CDA dividend. And if you're using corporately owned life insurance, you want to make sure that you've received the death benefit and that you took away this adjusted cost base before you paid it out as CDA. You're not going to be here when this happens, so tell your accountant to do it this way. And then this is where, if you were working with us, this is where we would handle the process and the communications. This is part of our service on these corporate-owned life insurance policies, or even like on your family life insurance policies. If you're a client of ours, this is what we would do, and we would coordinate. Number 4, you also want to be careful if you have non-resident shareholders. So anybody who lives outside of Canada who owns part of the corporation that we're talking about. And the reason you want to be careful is because these capital dividends may not be totally tax-free for them. In a lot of cases, the CRA imposes a 25% withholding tax on capital dividends that are paid to non-residents, unless you have a tax treaty with that other country that could reduce or eliminate the amount. Number 5 is you make sure that your account maintains proper documentation. So to avoid the issues down the road, you want to have clear paper trail documentation. Your lawyer, your accountant should file and store these documents every year. So you want to definitely have any of the calculations that you've done. So like, how did you calculate how much this is? If there's an insurance policy involved, you need the insurance policy documents, you need the numbers, you need the adjusted cost base. Keep organized documentation. This makes everything easier for everybody, especially if the CRA reviews your file. And over the last couple of years, the federal government have hired a ton of new people at the CRA to go out and audit Canadians. So make sure you keep proper documentation. Your accountant keeps proper documentation. Your lawyer keeps proper documentation if you ever need to talk to the CRA. Now, here is an example of a sample client. This is Dr. Wong. She's an incorporated dentist in Toronto, and she's going to use the CDA to get money out of her corporation tax-free. And this is a practical scenario that shows how the Capital Dividend Account can be used by incorporated professionals here in Canada. So Dr. Wong is a successful dentist and operates her practice through a CCPC, the Canadian Controlled Private Corporation. Over the past few years, she's built up investments inside the corporation. She's been profitable. One of those investments was a rental property. She bought it inside the corporation. It was a long-term investment. And recently, Dr. Wong decided to sell the property and realized a capital gain of around $1 million. And now here's how this breaks down and how she's able to get some money out of the corporation tax-free. So the capital gain is $1 million on this property. Half is taxable. So $500,000 is added to the corporation's taxable income. And then the non-taxable portion, the other half, the $500,000, is credited to the CDA of that corporation. So this means that Dr. Wong's corporation now has this $500,000 of tax-free capital surplus sitting in the CDA, ready to be paid out to her personally when she wants without triggering personal tax. This can pay out now, or this can pay out later, and she can pay out some of it or all of it. If she had paid herself a regular dividend instead, that could have been over $150,000 in personal taxes owing for, she's in Ontario, in Toronto, right? So this year. Next, there's the strategic use of the corporate-owned life insurance, which will eventually get the money out from her corporation to her family in a tax-free way. So in the corporation, she has these investments, she's got the real estate, but Dr. Wong also has a corporate-owned participating whole life insurance policy for $6 million. So in the future, when she passes away, her corporation is going to receive that $6 million as a tax-free death benefit from the insurance policy. And then for the CDA purposes, anything above the adjusted cost base is eligible to credit the CDA. So the death benefit that she's going to get is $6 million. We're estimating that at her life expectancy, the ACB of the policy is going to be around 600,000. So credited to the CDA is going to be 5.4 million out of the 6 million that gets credited to the CDA. This creates an additional $5.4 million in tax-free capital available to pay out from the corporation, either to her estate or to the beneficiaries, entirely tax-free, right, through the CDA mechanism. So what is the final result? And this was a rather simple case, right? So by combining the smart investing with the corporate-owned life insurance, she has the initial $500,000 CDA credit from that first capital gains when she sold the property, as long as she doesn't spend it while she's alive. And then she's got $5.4 million CDA credit from the life insurance in the future. And this is an estimated number because we don't know exactly the day that she's going to die. We don't know what those values are going to be on that date. So you add those two together, 5.4 plus $500,000 is $5.9 million total available to the CDA, which can distribute to the resident Canadian shareholders of that corporation, which of course, if you were doing a proper estate plan, would be your family, or it would be a trust, and it would pay out to whoever you wanted to pay out in a tax-free manner. And then they could use that money for whatever they want. So important considerations when you're using the CDA. You know, I've talked about all of the good. These are some things you got to watch out for. It is one of the most powerful tools that's available if you're an incorporated professional or if you own a private Canadian corporation. But again, like with all tax strategies, it has rules, it has compliance requirements. And to avoid costly mistakes or to avoid CRA penalties, you want to understand the key things to watch out for when you're using CDA to distribute dividends tax-free. Number one, and probably the most important rule, never pay out more than your CDA balance. This is the most critical rule when you're using your CDA. You never pay out the capital dividend more than your capital dividend balance. If you do pay out more than your CDA balance, the CRA could charge a penalty, and it might be a punitive rate that could be as high as 60% on whatever the CDA limit was that your corporation paid out, plus interest, and that interest compounds. So this kind of mistake is expensive. It's entirely avoidable with your proper tracking of the CDA and proper documentation. So again, work with your accountant on this and make sure that you're keeping track of your CDA over time. Number two, your accountant should keep accurate records, and they should reconcile, especially after capital losses. So your CDA balance changes over time, and there's things that can impact it. So capital gains and losses on corporate investments will impact it, obviously increasing it and decreasing it. And then if you get life insurance proceeds from a corporate policy, so maybe another shareholder for the company passes away, and that creates a CDA or it grows the CDA for the company. And then capital dividends that you get from other corporations. So like, again, I talked about all these before. If your corporation gets a capital dividend from another company, or even a capital loss that could offset a previous gain, right? That could reduce your CDA. So this is, again, why it's essential to keep up-to-date tracking of and to reconcile every year anything that impacts your CDA. And, you know, ideally, you're tracking this as it happens and you're not trying to just remember everything once a year, but definitely talk to your accountant and make sure that this is being tracked properly. If your corporation owns a participating whole life insurance policy, you also need to track the ACB of that policy, the adjusted cost base, since only the portion of the death benefit that's higher than the ACB credits the CDA. And so to do this, you would call us and we would get you this number each year. Actually, you wouldn't even call us. We would send this to you and to your account each year as part of our client service and annual reviews. We have an automated system to do this. Not everybody has that. And that's why you want to work with somebody like us. Number three, you want to file the proper forms. You want to file the proper forms with the CRA on time. Everything that we're doing here, this is all paperwork. And so you need to file the right paperwork at the right time. And if you don't file it on time, it can result in the dividend being treated as a regular taxable dividend, which eliminates the tax-free benefit and creates a personal tax liability for you. And it would be dumb and it would be expensive. And again, it's avoidable. So anyways, filing, if it's late or if it's wrong or it's missing forms, this can lead to what's called a reassessment. This can lead to penalties. So it's crucial that you work with experienced professionals like us in the process. You definitely don't want to be somebody's first client doing this. And you do want to work with somebody who is going to be there to service you in the future. So definitely work with good people on this. And especially, like I said before, they've just hired thousands of new people at the CRA over the last couple of years. So make sure that your documentation is correct and make sure your numbers are correct. And number four, There, again, talked about this before, there are special rules for non-resident shareholders. So if the corporation has shareholders who are not Canadian residents, the capital dividends could be subject to a 25% non-resident withholding tax, unless there's a tax treaty between Canada and whatever country that shareholder is there. And that tax treaty could either eliminate it completely or it could reduce it. So you want to consult with a cross-border tax expert if you've got a non-resident shareholder who's involved, because this CDA concept is really for tax-free distribution to Canadian resident shareholders, and it's always Canadian resident shareholders. You also don't want to be too aggressive on here. So number 5 is to make sure that you're not doing what's called anti-avoidance. So over the past couple of years, the CRA has implemented more anti-avoidance rules so that you don't abuse the CDA. All right, so CDA is great, but there are certain firms out there that are maybe abusing it or maybe being too aggressive. So any structure or transaction that appears to artificially generate CDA balances, or it manipulates the timing of a CDA balance or the timing of an ownership change so that you can have CDA, these all can be challenged by the CRA under GAAR, or your general anti-avoidance rules. And again, there were some changes made to GAAR over the last few years that made it much stronger for the CRA. So it's not really something that you want to play around with. Again, the CDA is great. And if it just works the way it works in the textbook, there are firms out there trying to do too much. It works great as it is. You don't need to try to do any tricks to do it. And now the CRA has really kind of over the last couple of years tightened up some law to make it harder to do that. As an example, moving a life insurance policy to the corporation right before you die, or within some years, or you shift capital gains from one corporation to another corporation so you can move the CDA around. This may not stand up under an audit. And to remain compliant, any CDA strategy needs to have what's called a legitimate business and estate planning purpose. And it needs to be properly documented, and it needs to be reviewed by professionals that know what they're doing. So, I've been talking about that throughout this whole video, is just, do it. It's good, but be careful and do it properly. Bottom line is, when it is used properly, the capital dividend account or your CDA, this can let your incorporated professionals or business owners to take out hundreds of thousands, even millions of dollars in tax-free corporate distributions to yourself personally or to your family. But if you do it wrong, or you work with people who don't know what they're doing, this can lead to audits, this can lead to big penalties, and this can lead to missed opportunities for real tax savings of doing it properly. So final thoughts is keep more of your money and transfer more of your money tax-free to your family. If you're incorporated, you own a business, you have retained earnings, and you've got corporate surplus, you've got investments, or you've got a life insurance policy inside that company, all of these things, that capital dividend account, it's not just a tax strategy, it is your opportunity to pull money out of the corporation without paying personal tax. This isn't a risky thing to do. This isn't some theory. This is basic. This is compliant. This is a proven way to get money out of the corporation cleanly, efficiently, legally. But the timing, the structure, the paperwork, those matter. Mistakes can be expensive. This could cost you thousands of dollars in penalty. It's going to cost you more accounting fees. It could cost you missed other tax savings opportunities. So if this is you, you've got an incorporated business in Canada, you're profitable each year, and you're looking to grow that surplus saving in a safe and tax efficient way, that's going to help you now, and it's going to help you in the future for your estate, for your legacy, for generational family wealth, then book a time to meet with us. It's super easy. You can go to our website, it's safepacific.com. There's tons of buttons on the website that you can click and book straight into our calendar, or click somewhere around this video or in the description, and you'll be able to schedule a no pressure discovery call with somebody on the team. Now, before you go, if you got a lot of value from today's video, can I please ask you for a favor? Click on all the buttons that make these videos spread more to more successful business owners like you. We're a rare breed in Canada, so click like, click on subscribe. Leave a comment. Anything helps with the engagement. Just say hello. Thanks a lot. That is it for me today. I will see you next time.